What's going on, guys? Welcome back to the channel. My name is Mark and this is 360 Finance. In today's video, we're going to be going through my top 3 dividend holdings to buy and hold for the next decade. So if you've been following this channel, you'll know that I just moved into this new house and I've actually just been in the midst of rebuilding my portfolio. So obviously I'm going to be showcasing some strong dividend plays to start off before I go into, the high tech or the growth stocks or the highly speculative buys. Today, we're going to be going over some safe, secure, boring dividend yield stocks that are going to be core holdings in my portfolio. Before we get started, I'd just like to let you guys know that over 90% of you guys that watch this content actually aren't subscribed to the channel. If you guys are interested in stocks, if you guys are interested in the stock market, if you guys are interested in improving your financial literacy, give the video a thumbs up, and if you are bold enough, subscribe to the channel. All right, guys, let's go ahead and jump into the video. All right, guys, so before we get started, first things first, you can obviously see my first pickup here, but the reason I'm going through these stocks is because I believe these are companies that are going to be around for the next 5 to 10 years. I believe that they're too big to fail, in essence. They're entrenched in their market. They're adaptable to any new trends that are going to be occurring within their respective markets. They're mature companies in the latter half of their business cycle. And they're not necessarily cheap, okay? These are expensive stocks, and I also own shares of all 3 of these stocks. So the first one is Waste Management, and I have the 5-year graph up here against the S&P 500 as well as Republic Services. And Republic Services is their main competitor in the US, but Waste Management still is kind of the dominant firm in the industry. So if we just look at some of their financial performances over the years, their revenue took a little bit of a hit in 2020, about 1.5%. Obviously due to the COVID-19 pandemic. And that's actually pretty good considering, what actually happened last year. There's always going to be trash to collect. When will there not be trash to collect? They do pay roughly a 2% dividend yield, which is why I will be buying this company, as it guarantees me income in the long term, and it's a relatively safe company as well, as it has a low beta. So like I said, their beta extremely low, it's below 1, so it's less volatile than that of the market. You would be buying a company like this to essentially reduce the risk in your portfolio, or you would be buying it if you're an income investor, which the core holdings in my portfolio will be. So even though it lagged the S&P 500 in the last 2 weeks, the main thesis for me on the stock is it's a dividend stock and it's safe. I'm not buying this company for growth. I'm not buying this company, for momentum. I'm buying this company because it's a steady Eddie. It's going to be around in 5 to 10 years, and it's going to continue paying me income over that period. So if we look at their financials, again, I said their revenue came down about 1.5% year over year, and that did hurt their bottom line here. Their current ratio is about 1, so they have just enough money to pay off their current debt. If we look at their EPS forecast over the last 4 quarters, you can see they beat it every single time, and their next earnings date is May 4th. Analysts a little bit mixed on this company. You see sitting right at the 2.5 rating. Half the analysts recommending a buy, half of them either recommending hold or underperform. So this has been a stock that has historically gotten 0 love from Wall Street analysts, and again, kind of mixed feelings. The thing with Waste Management is it's had such a good run in the last year or the last 5 years. Can we really expect that to continue? 100% in the last 5 years. Waste Management also remains one of the world's most ethical companies and has reached Ethisphere's list for the 12th time. This portion right here is what I believe to be the biggest selling point on Waste Management. If you look at their landfills and what they have locked up for the next, 10 to 40 plus years, and if you do the math here, 45 plus 63 plus 111 divided by 268, they have 82% of their landfills under contract for at least 11 years or more. So if you're talking about an income investment, this is a phenomenal company going to be having recurring and stable cash flows for the next, it'll probably end up being longer, but if for at least the next 11 years, 82% of their landfills are locked up in contracts. To me, this is the biggest selling point. The number 1 selling point on Waste Management is their stable cash flows and the amount of business that they have locked up for the long term here. They also have a history of increasing their dividend, which is the main reason, again, that I am buying this company. I'm an income investor, at least I will be to start off in these core holdings, and they just announced that they're increasing their dividend by about 6%. And you can see that if we look at their dividend all the way back till 2011, it has historically increased every single year, all the way back to inception. So management consistently raises income. So this is a great reason to be buying Waste Management. At the end of the day, Waste Management has irreplaceable assets. 82% of their landfills are locked up for at least the next 11 years. They're consistently increasing their dividend and providing value to shareholders, and they're a stable, steady Eddie type of company. I understand that the valuation may be a little bit rich, but this is a company that's going to be around for the next 5 to 10 years, likely even the next 20. The last thing for Waste Management before we move on to the second pick, insider trading. And I know if you're looking at this, you might be thinking, well, every single insider is selling their stock. Like Peter Lynch has famously said, there's many reasons that people can be selling a stock, and there's only really one reason that people can be buying. Okay, so for instance, if these people are selling off, maybe they're buying real estate, maybe they're closer to retirement, maybe they just need a little bit of income to pay for certain bills. There isn't a lot of purchasing in terms of insiders for the last few years, in fact, zero from what we can see here. At the end of the day, I don't think this is alarming because Peter Lynch, again, has famously said, one of the best investors of all time, there's numerous reasons people could be selling, and it isn't necessarily alarming to see lots of insider selling. Okay, so just to wrap up, Waste Management, number one pick, stable, steady Eddie company, has a history of increasing dividends. This company is gonna be here for the next 5 to 10 years, likely the next 20, and they're just a reliable business. Let's go ahead and move on to the second pick. All right, guys, so my next pick here is Microsoft, and the basket of companies that I've shown in this graph is Apple, Amazon, and Facebook. And I know that despite these companies having very different business models, the reason I've used them as a relative price, I guess, indicator here is because these are all massive tech conglomerates. You can see that Microsoft actually isn't the best performing one over the last 5 years, and in the last year, it isn't as well. From a maximum perspective, though, it is, okay? Now, that's not the main reason to be looking at the price graph, but at the end of the day, I'm buying this company because, again, this is another steady Eddie company. You're probably paying for a little bit of growth here since it's a technology company and they have a variety of income streams that would probably be considered growth instead of considered stable. But also, they pay a dividend, okay, of roughly 1%, and I know that doesn't keep up with inflation. And their PE ratio isn't cheap relative to these other tech conglomerates either. But at the end of the day, Microsoft is a company that's entrenched. It has so much market share. It's adaptive, has great management. It's involved in the cloud business. Do you use Word? Do you use Excel? Do you use PowerPoint? And the chances of you using that for the next 10 to 20 years are probably extremely high. I know there's a lot of copycats, but there's just so many organizations, so many governments, so many contracts with Microsoft that use Office 365 and that will continue to use it in the future. Okay, let's dig down a little bit further into their financials and just some trending news of things that I've been looking at. Before we get to cloud computing, I want to just talk about the insider trading that's been going on. So there was one big insider purchase at Microsoft this week, and it was one of their directors, Emma Walmsley. She bought about $1 million worth of Microsoft shares. Sorry, it wasn't this week, it was 2 weeks ago. But again, like Peter Lynch said, there's many reasons that insiders may be selling, but there's only one reason that they're buying, is because they believe the stock is going to go up. So let's just take a look at their insider trading here. And not a lot of purchases, mainly selling, but we do have a purchase here. And whenever we have some sort of director, whenever we have somebody in senior management of a company buying shares, it's likely a sign that they believe the stock is undervalued and that it's going to be going up. Now, this is a company that already saw a lot of growth, especially during the COVID-19 year, and it's not a cheap business to buy. If we go back just to some of the technicals here, it has a market cap of almost $2 trillion. Price to earnings ratio over 30, okay? This isn't a cheap company. You're buying it because it's a steady Eddie company that's so big that it's too big to fail, and it also does pay a dividend yield. If we just go to their most recent earnings release, you can see a snapshot of their business here. This is very high level, but I just want to point out a couple things. Their Microsoft 365 consumer subscribers almost hitting 50 million here. Their cloud revenue, their LinkedIn revenue, up 23 to 22% a year over year. And if you're just wondering why it has two percentages here, just because one of them is in constant currency and one's not. Obviously, Microsoft's a massive tech conglomerate. They're a global business and they have currency all over the world. So the first one is the generally accepted accounting principles, which is a US measure, and then you have constant currency in percentage as the second one. It doesn't deviate too much in, well, it doesn't, some of them, like you can see your commercial bookings commercial bookings worldwide, obviously, depending on which currency you measured in. The biggest thing here is you really don't see negative growth, except for the Windows original equipment manufacturer, but that's fine. I'm actually not concerned at all with their personal computing section. The main sections I'm interested in is the cloud revenue and also the Office 365. Those are catalysts not only for growth, but just for steady cash flows into the future. Okay, so if we just look at the quarterly business highlights, again, LinkedIn revenue up 23%, 22% in constant currency. Their server products and cloud services revenue increased 26%, driven by Azure revenue growth of 50%. 50% revenue growth in the Azure. To me, the main thesis about buying Microsoft is, again, it's too big to fail, and they're massively involved in cloud computing. In fact, they're probably the #2 competitor behind Amazon. More recently, one of their corporate VPs, Omar Abash, had written a blog post on the Microsoft site, and I just want to read what he wrote to give you an idea of what this company is doing and where they're positioning themselves long-term in the cloud business. So what he said in the Microsoft blog post cited above, corporate VP for cross-industry solutions, Omar Abash, wrote, "We know that in asset-intensive industries such as manufacturing, automotive, or logistics, companies face unique challenges in adapting to new technologies. For example, connecting industrial equipment safely and securely to the cloud, overcoming data silos, and supporting interoperability across modern and legacy systems. Through recent projects, I've seen firsthand what the Marsden Group and Microsoft can do, what's possible when we bring together our cloud, edge, Internet of Technology, digital twin, and AI capabilities with the Marsden Group's speed, agility, and technical creativity." And sorry, maybe I'll just back up a bit. If we actually look at what the blog post is, Microsoft acquisition reveals huge ambitions in the red-hot cloud industry. To me, cloud has been around for a few years now, but it's still very much in the infant stage of its growth. And there's so much opportunity in this industry, and this is a recent acquisition by Microsoft, the Marsden Group, and you can see that they're looking to leverage these smaller companies' core competencies and use them to acquire further business in the manufacturing, automotive, and logistics sectors. This is a massive conglomerate, Microsoft I'm talking about, and they're going to continue to build their revenues in any way they can. And I think there's so much opportunity in this cloud computing industry. If we just look at them relative to some of the other major competitors up here, so again, AWS is kind of the main player in the cloud industry, and then right after them you have Microsoft Azure, okay? So you also have the Google Cloud and the Alibaba Cloud, but the two big ones here are Microsoft and AWS. So as of Q4, worldwide cloud infrastructure spend grew 32% to almost $40 billion, driven by increased digital transformation and greater use. Just the opportunity in the cloud computing market is just massive. If we just look at this graph here from Grand View Research, you can see they're expecting it to grow at about a 15% compounded annual growth rate until 2027. And then they've broken down, of course, the industries where they expect growth. At the end of the day, what do you see here? You see an exponential graph going upwards for the cloud computing industry that's going to be connecting to other industries such as the Internet of Things, edge computing, 5G, artificial intelligence, machine learning, all that good stuff. And Microsoft's at the forefront of it. I said these picks were mainly for income. So if we just look at the history of dividends for the Microsoft company, also just like Waste Management, since 2011, they've been increasing that dividend steadily. And you could probably expect that to increase in the future as well, as this is a company that's almost worth $2 trillion. So just to wrap up, with Microsoft, you're getting another company that's too big to fail. It's entrenched in their market, has a history of increasing their dividends, and you're likely going to see a little bit of growth when it comes to cloud. And then their steady eddy cash flows, you have LinkedIn and you have Office 365, which is going to be here for at least the next decade, probably even longer, let's be honest, okay? Let's go ahead and move on to the last pick. All right, guys, so final pick here, and another very boring, steady eddy type of company. What we have up here is McDonald's, and we have its basket of companies I'm comparing it to, which is Domino's Pizza, Coca-Cola, and Walmart. And there's a variety of other companies that we can compare them against too. But similar to Microsoft, similar to Waste Management, you're not paying for a cheap company here, okay? Valuation-wise, most analysts probably look at this stock and say it's way overpriced, or there's no room for growth here, okay? So you can see it's been the best performing stock of this basket of companies over the past year. And if you look at the past 5 years, it's about third. For some reason, Domino's Pizza has been like this amazing stock for the last 5 years. I really have no idea why, but anyways, and if you look at the max graph, well, I did not know Walmart was that high, but if you exclude Walmart, you have McDonald's Corporation performing the best out of this basket of companies. Year to date, it has also been the best performing company. I actually scooped it up in February, which ended up being a good time to scoop it up apparently. But at the end of the day, why are you buying a company like McDonald's? Same reasons as the other companies. It's too big to fail, entrenched in its market, that there's no way that McDonald's is not going to be here the next 5 to 10 years. From a valuation perspective, yes, they may not be a cheap company to buy, but this is a company that's adaptable. It can adapt to new trends in consumer eating. It has just so much real estate worldwide that even if people stopped going to McDonald's, they'd be able to sell all the real estate and continue paying their dividends, okay? Pretty expensive company at a price to earnings ratio of 35. Dividend yield is about 2.3%, which is solid, and a market cap of about 165 billion. Again, not a cheap company, and you can see actually declining revenues for the past few years. They're going to be a company that maintains their dividend, and they're a company that's gonna be here in the next 10 years, okay? So from an equity risk premium standpoint, probably not going to get the best return in terms of capital gains, but this is a company that is steady Eddie when it comes to its dividend yield. And as you'll see, once we get to their history of dividend yields as well, they do have a history of increasing them. Okay, so one thing about McDonald's too, and this is something that struck me back when I was in university, I used to go to like all these events where like investment bankers and financial advisors and stuff from like the big 4 banks in Canada or the big 5 banks in Canada would just like show up and like give stock pitches or just like how to like break into the industry and stuff. One time there was a question asked about McDonald's for some reason, and this is kind of when I came to realize that McDonald's is a stock that's just, it's so loved by institutional investors. It's a core holding in institutional dividend portfolios. Just look at these analyst recommendations here. It's trading at its all-time high. There's no clear path of growth moving forward, right? Like they're already entrenched in like 100 different countries, and still every single analyst recommends a strong buy or a buy on this company. It's astonishing. They get so much institutional love. It's just a company that's gonna be around and continue to pay good dividends for the next few years, or even longer than that, you know what I mean? From a financial standpoint, declining revenues, a little bit concerning, no doubt. Okay, so also another company that has an extremely low beta, so you would be buying a company like this to reduce the risk in your portfolio. If you're an income investor, solid 2.3% dividend yield. McDonald's is almost more of a real estate company. You can see they have about 38,000 locations worldwide here in about 100 different countries. There has been a little bit of dispute between the franchisees and corporate over the past few years, but at the end of the day, I think they're going to be fine. Okay, so I have a few different articles up here, and I was thinking about going through them for this video, but I'm looking through them and reading through them again, and I don't think this is necessarily super important information. I'm gonna scroll through it for you guys so you can read it yourself. You can pause the video if you'd like to go through it. But the main thesis on McDonald's, from my point of view, is, and it's the same ones as, it's the same thing as the other ones, okay? And I'll scroll through these articles just so you guys can read them, as I talk here. But this is a company that's too big to fail. It's adaptable to future trends or shifts in the market, and it'll engulf any new and upcoming competitors that have lots of hype. Okay, with 38,000 locations worldwide, this is a real estate company. It really is. That's what this is. This is a real estate company, and they pay a solid dividend yield. I expect them to be here for the next 10 years. And once we get to their dividend here, you'll see that they also have a history of increasing their dividend yield, okay? And then you can see, actually, if you search McDonald's online, you'll see that a lot of people say it's not a buy, but people have been saying this for years. And I understand that it's trading at its highest multiple ever, but to me, this is a company that will never fail, even if you don't like McDonald's. Okay, so looking at their insider history, this company has certainly had some insider buying. You go all the way back to 2019 though to see some of it, which is fine. You saw a little bit right before the COVID-19 pandemic. And again, if we go back to Peter Lynch's quote, there's various reasons that people can be selling their stock. There's only one reason that they'll be buying it, is because they expect it to appreciate. And you see the most insider selling out of any company that we've gone through today. Okay, and last thing before we finally wrap up this video, Look at their dividend all the way back to 2013. All the way back to 2011. Again, history of increasing their dividend. When you're an income investor and you see a history of increasing dividends, music to your ears. Just to wrap up, McDonald's history of increasing dividends, too big to fail, and it gets so much love from institutional investors, and it will likely continue to get love from institutional investors. All right, so that's pretty much all I have for you guys today. I hope you guys enjoyed. If you did, definitely let me know down in the comments. Like the video, subscribe to the channel, and I guess just some context for you guys. I haven't made a stock video in quite a long time because I've been rebuilding my portfolio here as I had to save up for like all of last year during the COVID-19 pandemic to buy this house. Anyways, I'm going to be making a lot more stock videos moving forward. Let me know what type of stock videos you guys would like me to make. Do you just want to know what I'm buying? Do you want to see me do some analysis on some, high growth, high flyers, some new IPOs, some hot stocks that people are talking about? Let me know down in the comments. I'd love to hear what you guys think. And, at the end of the day, this channel is for everybody that's watching it, not necessarily for me. Okay, so let me know what you guys want to see down in the comments, and I'll see you guys in the next video. Peace.